All right. Hello, and welcome back to our weekly Tech Talk series from MarketEdge.com, your source for unbiased technical stock research, where our resident CMT, David Blake, reviews the previous week's stock market activity and gives you some pro tips on what to watch for as we move through the week. Last Monday was Labor Day, so markets were closed, and we don't usually do Tech Talks on those short weeks, so we've got 2 weeks worth of market activity to cover today. I won't waste any more time, so let's turn it over to David to jump right in with last week's weekly market letter.
All right. Well, coming out of that long holiday weekend, we had kind of a rough start to the week. We actually saw the stocks tumbled into September, as they say. The Dow was actually down almost 600 points on Tuesday before investors jumped in and bought the dip. A lot of that was because of a surprise ruling over that following weekend about Trump's trade tariffs could be illegal, and they were trying to figure out how that's going to affect the economy and that kind of stuff. And then there's still concerns about the independence of the Federal Reserve, although today the White House made a thing that they definitely want to keep the Federal Reserve independent. And that, I think that's one of the reasons we got a little bit of a bounce this morning. So anyway, so the investors came in, they bought the dip. We did get some key jobs data as the week was ending. It came in and showed Friday's BLS job report showed only 22,000 non-farm payrolls were added in August. And that was down from what they were expecting. They were looking for, I think, 75,000. So it was kind of a big drop. Rates fell down a little bit. We now pretty much have a quarter point September rate cut on the books. And they actually now have some calling for a half a point rate cut. But as of this morning, when I looked, there's a 100% chance of a rate cut in next week's FOMC meeting, and about a 12% chance of a half a point. Some of the data that we get this week actually could influence that a little bit. But then we go out and we have an 85% probability of a rate cut in October and a 78% in December. So the market basically starting to price in 3 rate cuts. And that's pretty aggressive. If you go back and look at the historical data, when the Federal Reserve begins to aggressively cut rates within the next year and 2 years, the market's up pretty healthy, and it's been up as much as 50%. So I think we're probably due for some pretty good market action here going forward. And we saw the yields tick lower. The 2-year T-bill fell all the way to 3.53. It actually was below 3.5% for a little while on Friday. That's the lowest since 2022. And then we saw the 10-year Treasury come in around 4.09. That's the lowest since early April. So the yields are moving lower. That's usually a good thing unless it gets to the point where they start moving so low to the point that analysts start looking whether or not we're going to have a recession. But right now, no one really is priced in a recession at that point. So that's good. As far as the sectors went last week, we were starting to move ahead, and then we ended up on Friday having a little bit of sell-off again with the jobs report. But we had communication services actually hit a new high. That was on a big 9.5% spike in Alphabet or Google after they won an antitrust case that will prevent it from selling off Chrome. And then a nice jump in Amazon and better than expected earnings from some of the retailers like Macy's and American Eagle and others to help the consumer discretionary outperform. On the flip side, we had energy, financial, and utilities were the weakest market groups. That, nothing real surprising there. We're kind of in the early cyclical stage of this recovery right now. But anyway, we did end up mixed last Friday when at the close. The Dow was down a little bit. S&P 500 was up a little bit. The NASDAQ had a real good week, actually. It was up 1.1%. And then we saw the small cap Russell 2000, which is one of the main benefactors of lower rates. It traded higher for a 5th consecutive week. And it's getting close now to the point where we could see the small cap Russell 2000 make a new high. The last time it made a new high at 24 something. 24.42. It was back at the end of November, the beginning of December. So that's all good for the market going forward. The technical condition of the market is kind of mixed for a second week, because the previous week we had a mixed market going on there. And then this week we were mixed also. We had the technical indicators are kind of settling in to neutral reading. MACD is kind of a short-term trend gauge. It's mixed. Momentum, which is based on the 14-day RSI, it's positive, but it has slowed quite a bit. So it's not, we're not seeing a runaway market where everybody's jumping in. Part of that reason is because historically, this is a kind of a weak seasonal period for the market. Going back, I forget, 50 years or something like that, the S&P 500 has averaged about a 1% loss in September. So we got a lot of important economic data points coming out. And I think investors want to make sure that we don't see a big drop off in jobs where it looks like we're in for a recession. And we also, the flip side of that, they don't want to see the data that's coming out later on this week, like the CPI, jump up and show a bigger jump in inflation that would cause the Federal Reserve to maybe reconsider a rate cut next week. So anyway, that's what we're doing right now. I do think we'll probably see dip buyers step in every time we see a little bit of a pullback here over the next week or so ahead of that FOMC meeting. Underlying breadth was also mixed last week. We did see the NYSE advanced decline line, which is the key leading indicator for market direction. We look at it. It made a new all-time high on Thursday and Friday. So that's a plus for the market going forward. NASDAQ AD line was a little bit lower for a second straight week, but that's not as watched as much as the NYSE market. And then we also saw another week of new 52-week highs outdoing the new lows. Market sentiment, it's not bad. A lot of times when you're making new highs, what you want to watch out for is investors, institutional and retail, getting a little bit frothy when they start getting new highs. Like, we got to jump in there. This market's going to the moon. We still have the retail investors, according to the American Association of Individual Investors, it's still below the historical average of 37.5% retail bulls. We're only at 32.7. So that's something to consider. And then you had a second week of institutional and hedge fund buyers just trimming their exposure to equities. We were at 98.2%, fully invested 2 weeks ago. We've cut that down to 81.6%. I think, again, that's probably just the hedge funds trimming off a few of the big winners, the high PE stocks going forward. So nothing big there. And again, with the seasonal weakness, they don't want to be completely all in at this point. So in general, I think things look pretty good. This week coming up, there are a couple of key things. Tomorrow, they don't talk about it much, but tomorrow we get the BLS is going to announce job markdowns. And what we want to watch out for that is that what they're looking at, probably they'll mark down for the year. I think Wells Fargo is looking for them to trim jobs by about 475,000 over the 12 months ended last month. But then if they do, that will probably put jobs growth for the previous 12 months at around 83,000 to 110,000. And that's compared with what we're holding right now at about 149,000. If we would see a report much weaker than that, where all of a sudden you show with 12 months where you were down to maybe 25 or 30,000 jobs for that again would probably be met two different ways. One would say the Federal Reserve has to get more aggressive than what they had planned on, and we'd start talking about a 0.5 point rate cut again. And then also you might get a little bit more of this job's really weak, we may be going into a recession. Now, after that, on Thursday, we get the August CPI, and that we're looking right now for a little bit of an uptick again. I think for the second month, we're looking for the core CPI and the headline CPI to be up 0.3%. But they're looking for 2.9% year over year on the headline CPI, and then 3.1% on the core CPI. So it's not like they have inflation under control here, but when you weigh it with the jobs data, they have to kind of prop that up also. And they're hoping that from the Fed's reactions, they're hoping that some of these numbers will start to pull back again once we work our way through the tariffs. And hopefully that is what's going to happen. And then on Friday, we have the University of Michigan releases a consumer sentiment. We're looking for a 59.3. That's about a point higher than what we were in August. One thing that they do kind of look at on that is the consumer expectations for inflation going out 1 year. And right now, I think we're looking for about a 4.8% rise in inflation going out 12 months, which isn't great, but they'll still have to cut rates to get the jobs data going in there. So as far as what we're looking for the week, we kind of keep an eye on that. Next week, we get the big FOMC meeting. It starts on Tuesday. We'll probably get the rate cut on Wednesday. Some of this data that we're going to balance this week, if it comes in worse than what we're looking for, or if inflation comes in a lot less than what they're looking for, maybe you start talking about another 0.5 point a half-point rate cut instead of a quarter point. But I don't really think that we're going to see that. The Fed Chair Powell has always been a little bit more conservative with this, and I think he also doesn't want to show that he's bending to Trump's pressure to get more aggressive on cutting rates. So that's what we have right now. Today, we have a pretty good day on the NASDAQ. I think the NASDAQ actually is hitting a new high. The S&P 500 is off about 3 points from another new high, and the Dow is down about a 0.25%, nothing big. As far as the underlying breadth goes today, nothing great. It's kind of flat to even. So again, I think people they're just kind of biding their time in here. We'll get the numbers coming out here for tomorrow and on Thursday and see how we roll from there.
All right, very good. Anything else to add today?
No, but again, don't be surprised if we see the dip buyers coming in all week. I do expect that. So if you see it, we'll get a little bit of a surprise and market falls down. Don't be afraid to maybe nibble on a few things as we roll forward.
All right, very good. Thank you very much, David. We'll talk to you next week.
Okay, Rachel. Have a good week.
You too. If you're interested in learning more about technical stock analysis with easy-to-read opinions updated daily, check out marketedge.com to start a free trial today. Otherwise, if you're on YouTube, please like, subscribe, and comment to let us know what you think about this week's stock market news. Thanks so much for watching, and we'll catch you next week.
That good?
Perfect.
All right. Have a good one. Bye-bye.